Hey, welcome to Financial Revelations. I'm David Zafransky, your host. You can hear me every week on Financial Revelations, and we're going to start a new little feature next week. I'm really excited about it, called Quick Hits, where if something happens during the day and we want to let people know about it, we're just going to get online and give it to you. Might be a minute or two at most, just a little quick hit. And might be a financial planning idea, might be a company report or something like that. But it happens all the time when I'm sitting at my desk and watching, reading, doing research and things like that. So talking to people. So we'll be looking for those things next week starting. And as always, you can call us if you have a question, 1-800-344-2534. 1-800-344-2534. You can listen to me on WCRF 103.3. It's a Moody Radio station. They do have a Moody Radio app. You can listen anywhere. But Thursday mornings from 8 a.m. to 9 a.m. is Moody Radio in Cleveland. And then if you want to email Corey at epsf.com. So we're very gettable. You can get to us. We like to answer questions that people have, because if you have it, probably other people have. But I have a question for you that I want to start out with. What do you think of this new sweater? There's no wrong answer. You might not like it. You may like it. I saw it on online, and I thought, yeah, I want that. It's 100% wool, so I got to dry clean it. So I have to eat very carefully. I just had Thai food for noodles for lunch. I don't think I have any on me, but I sure hope I don't. I like it, but if you don't, I'd like to hear from you. You can get us on Twitter too, at SkiBucks1, the number one, at SkiBucks, the number one. Twitter is kind of a weird thing right now, where it's kind of the fervor over Elon Musk buying it seems to be kind of dying down a little bit. I do like Twitter. There's a lot of news released there. A lot of the advertisers that left when he first bought it are coming back. McDonald's is back. I'm pretty sure Coca-Cola's back there. It's a great way to advertise, because it's very targeted. Very, not as targeted as Facebook. And Facebook is so targeted because you are the product on Facebook. If you're not paying for the product, you are the product. And on Facebook, you are the product. And how do they know so much about you? Well, you've told them, you've given them all the answers. People put their pictures, their likes, their dislikes, everything they do, where they grew up, who they're married to, their kids, the things that they like. And if you leave your Facebook account logged in while you surf the web, they're going to cookie you to death. And so if you go look for a new car or a new sweater while your account is logged in, all of a sudden those things are going to be in your feed. Facebook just reported this week their earnings for last quarter. They, for the first time ever, surpassed 2 billion daily users. 2 billion daily users. Those are all what we call advertising units. And so you're getting advertised to. That's the deal we make with Facebook. So anyway, we will be back on a daily basis sometimes with quick hits. You know, I was wrong about the Fed this week. Last week I was wrong about what I said they would do. I'm not wrong about the Fed. At least what they would do, I was wrong about. I said that they would raise interest rates by 50 basis points, and they didn't. They raised by 25 basis points. I said 50, they did 25, and then the employment report came out this morning, and it blew the doors off any expectations. Even the highest expectations were nowhere near what this employment report was. It was like 537,000 jobs last month. Now that's good news. People are working. The unemployment rate is 3.4%. But right now, and I know this is going to be, a lot of people aren't going to like what I'm going to say next, but good news is actually bad news right now. The Fed wants unemployment in between 4.5% or maybe 4.25% to 5%. I think they'd be happy somewhere in that range. And it's going the other way. The Fed wants to put some slack in the labor market so that somebody washing dishes at Wendy's doesn't have to be paid $25 an hour to do it. You know, when we talk about living wages and things like that, which is the argument for communism and a universal basic income, they always find somebody that has 4 or 5 kids and they're working at McDonald's or a fast food restaurant, and they say things like this. They say, I don't know how anybody expects me to support a family on this wage. And I have to say, you're right. I don't expect you to support a family on that wage. It was never meant to support a family on a fast food wage. That's a teenager's wage. And so what happens is people, they kind of slack off in high school. Okay, well, kids, we could do that. And then we don't get trained. And then we don't go back to school. We get no skill set. And so we're really forced into jobs like working fast food, earning a very low wage, trying to make the argument that any wage, any job should support a family of 4. That's just not true. And I hate to break it to people, but you got to get and stay educated. That's the world that we live in. And so if you didn't get and you didn't stay educated, that's not my problem. And I don't want to be mean to people or harsh, but in some sense, this is a harsh reality for a lot of people. You're not going to support a family of 4 on a fast food wage. It was never meant to do that. It's really meant for 16 to 19-year-olds and kids home from college in the summer. That's it. You got to go and get educated and then stay that way. So the Fed doesn't want people making $25 an hour at Wendy's or McDonald's or Arby's, or you pick your fast food place. They don't want that. So we need really 4.25% to 5% unemployment, and that's what they're shooting for. So why is this good news, bad news? Because it means the Fed should have done 50 basis points yesterday, on Wednesday. They should have done that. And now what they're going to do is they're going to stretch out the rate hike cycle to June and maybe even July at 25 basis points a pop. Now that's, it's not that bad in one meeting, but you do this over 3-4 meetings, you do 25 basis points over 4 meetings, we're % higher, which is where I thought we would be anyway. And I think that's what's going to happen now. I think they're going to go at least one more percentage point higher, 25 basis points at a time. And I think the market would have accepted 50 basis points. I don't think the market would have sold off. It kind of sold off today when that employment report came out, because that puts the Fed back in the box again, and they have to raise rates. So, earnings have been okay. You look at some tech companies, they did okay. Apple reported not a stellar quarter. They had some supply chain issues, and there's a lot of things going, a lot of noise in their quarter from China manufacturing. Their stock was up today. I think the market expected it to be a lot worse. So when the Fed did raise rates 25 basis points, initially yields fell. Mortgage rates came down a little bit. And then after the employment report today, they went right back up. And the 1-year Treasury, 1 year, so it's going to come due approximately 1 year from right now, it's at like 4.75%. Yesterday it was maybe 4.58%. So yields are going to rise, and they're going to continue to rise, probably at a slightly measured pace. And we are buying more bonds right now. I love the bond market right now in a lot of ways. It does allow me to take some risk out of portfolios. And even corporate bonds are starting to get really compelling. So because there's more risk in a corporate bond, because if that company goes bankrupt and they default on the bonds, you might not get back your principal or your interest. They pay higher than government bonds, which are guaranteed. And that leads me to one of our listener questions. How long do government bonds last? And what they're asking in that question is, what's the duration? When do the bonds come due? And that's the good thing about government bonds is you could really pick it. So if it's a new issue bond, you could do 3 months, 6 months, 9 months, 12 months, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 15 year, 20 year, and 30 year. Yeah, new issue. You could also buy a bond that was a 30-year bond that's going to come due in a year, because there's always somebody looking to get cash out of their bonds. So that's called an existing bond. It's not new issue. Or you can also do your own time frame. I happen to like the latter bond. So you start out with maybe 3 or 6 months, and then you go to a year, and then you go to 18 months, and you can do that with all different types of bonds, corporate bonds, government bonds, foreign government bonds. I was looking at foreign government bonds the other day, and at first I didn't realize that they hadn't been denominated in dollars yet. So in the local currency, it was paying like 12%. Like, wow, that's compelling. And then when you denominated the bonds in dollars, the US dollars, they were paying 3%. Well, our bonds pay more, so there's no sense in taking that risk. So we didn't, because we could get a one-year bond at almost 4.8% right now. And I think those rates are going to go higher. I think the Fed is going to be forced, when you see unemployment numbers like these, employment rates like these, 3.4%. Richard Nixon was president last time we had an unemployment rate this low. That's good. When unemployment rates go up, it hurts. People are out of work. We don't want to see people out of work. There are 10 million jobs open right now with 6 million unemployed people. So theoretically, everybody should be able to get a job. Now, that's not going to happen, but the Fed is back in this box where they're going to be forced to raise rates. They don't have another meeting until March. I don't think they're going to go a half a point again. I think they're going to continue on quarters now because that's where they're at. And if they went to a half a point, that would scare the market. So if they had done a half a point yesterday or Wednesday, it wouldn't have scared the market because the last one was a half a point. And even though the market wants a quarter and some people want to stop entirely, it's obvious now that that can't be done. So rates are going to go up. If you have questions, I want you to reach out to us. Look for the quick hits next week. I'm going to do at least 2 of them and just pop in online. We'll give you the quick hit and then we're out. And then we'll do the regular broadcast. We usually record on Thursdays or Fridays. We had illness on the team this week, so I didn't want the team here if they're sick. I don't want to get sick. You know, it's really hard when your team is sick, but it's way harder when I'm sick. So while I feel for the team, I don't want to be sick. You know how to get a hold of us. It's probably scrolling right here under my lovely sweater. And I want to thank Corey for the updates to the website or to the podcast. It really does look nice when I look at it. And, you know, I like to tell people I could sit down and talk for 4 hours and say not a lot. And so for me, writing something out and talking about it and staying on task, it's not very easy, but all the work that goes on behind things, there's a lot more to it. So I am very appreciative of that and of you guys listening and watching. And we put it on Facebook now and Twitter so people can see it. So let us know what you think. Tell me about my sweater, whether you hate it or love it. Thumbs up, thumbs down, burn it, wear it. I don't know, whatever you want to say. And I look forward to talking to you guys next week on Quick Hits and the regular broadcast. I am David Safransky, a real American and the voice you can trust.